Then we have at the top of that pyramid, the central banks. Top of that pyramid, the central banks. The central banks are the ones that controls, that maintains, that manages the country's money value, supply of money, and interest rates. We've actually put central banks above governments because central banks are supposed to operate independently. The government cannot actually influence the actions of the central bank. The tools of the central banks are policy adjustments and economic sentiment by voicing out their overall economic sentiment, interest rates decisions and statements, their plans of where they think is going to be heading, and quantitative easing, QE, whether they're printing more money or not. So those are the tools that the central banks can use to manage the money value, the supply of money, and the overall inflationary growth or inflationary levels in the country. The central banks in the US is the FOMC. The central banks in the UK is the Bank of England, European Central Bank for Euro, Bank of Japan, Reserve Bank of Australia, Bank of Canada, and the Reserve Bank of New Zealand. I'll show you the main items, the main news items that you want to pay attention to when you're looking at central bank activity. Number one of all the central bank, the FOMC. The FOMC is the US central bank. They will release their Fed funds rate, federal funds rate, which is the interest rates decision from the FOMC. They do this on a periodic schedule, but it's only released at 2 a.m. GMT plus 8. At 2:30, they'll have the press conference and also the statement being released. What you want to take note of at 2:30 a.m. is that if you're not used to trading at these hours, 2 a.m. GMT plus 8, my best recommendation is don't trade during the FOMC at 2 a.m. Because what's likely to happen is that you will either wake up at 2 a.m. to try and trade, and if you do that, you're going to try and force a trade because you have taken that extra effort to try and trade this news. Even if it doesn't move, you will try and put in a trade to try and get a reward for the extra effort. That's one scenario. The other scenario is that you stay up to 2 a.m. and you've gone through the whole day. You stay up till 2 a.m., 2:30 a.m. for the press conference. They start talking till 3:30, 4 o'clock. You're super tired and you just want to go to bed. You're groggy, you won't pay attention to what's being said, but you've put in that effort to try and trade, so you would force a trade again. A lot of times, you don't need to be trading at this 2 a.m. or 2:30 a.m. news. In the Traders Club, I actually do a lot of the pre-planning, the pre-trade plans for these news, running through the scenarios, setting in orders, market orders, stop orders, buy orders, sell stops, sell limits, all those orders set in place so that, and I'll share that with you in Traders Club, so that you don't have to stay up at 2 a.m. or 2:30 a.m., 2, 3 or 4 a.m. to trade the FOMC news event. You can put in those orders beforehand so that you know tomorrow you wake up, it's either you have managed your risk, you might have lost some money, or you have managed your risk, you would have made some money. At least that way, it's going to be a lot less emotional, a lot less taxing, a lot more manageable. So the FOMC, I would say, especially if you are new to trading, probably stay away, do the analysis, put in the orders, watch my analysis as well. I can guide you through that, and then avoid trading at that particular time. If you want to be trading news, the press conferences itself, you want to be trading the news event itself, the central bank news event itself, I would actually suggest trading during the Bank of England's rate decision. Official bank rate is when the Bank of England actually announces the interest rate decision. This is usually done at 7 p.m. GMT plus 8. So that's where they announce the official bank rates. At 7 p.m. GMT plus 8, they also tell you the official bank rate votes, how they have voted to come to that decision of whether to increase, whether to hold, or whether to cut interest rates. And also a monetary policy statement summary where they actually tell you why they have decided to increase, cut, or hold interest rates from the Bank of England. At 7 p.m., this will be a more likely or more suitable, more conducive hour that you could be trading during that news. But again, if you are new to trading, I would still best suggest to stay away from trading any central bank news. I would still best suggest that as I share my views and my analysis of the Bank of England or the FOMC or any central bank and rates decisions, I'll be telling you where you could be setting your entry levels, where you could be setting your stop losses, and where you could be setting your take profit levels, guiding you through this whole process. The Bank of Japan, you'll see that it says around 10 a.m. GMT plus 8. The Bank of Japan does not do a press conference, fortunately, because they'll be speaking Japanese, but they do release a monetary policy statement, but they do not actually tell you exactly what time they'll be releasing that statement. It's always within that period of about 10 to 11 to 12 o'clock GMT plus 8. So what you want to do during this period is you want to be there. You know that you've set aside that time. You know what to focus on. You could look for the policy statement. You can look at the charts. You can see how the statements move according to what's being released on the policy statement. A little hint, a little tip is that you'll find as you compare monetary policy statements from the Bank of Japan that they're going to be very, very, very similar. On a month-to-month basis, as they release the monetary policy statement, it is going to be very similar. It will almost look like it's a photocopy. Go through the statements because one small change, which is the QE, one small change in the amount of how much the Bank of Japan is printing could have a massive impact or significant impact on the Japanese yen. So although it will look like it's a repeat over and over again, this is still one of the news items that I focus on quite heavily, especially because it's at a good timing that I can trade at. It's a good timing that I can plan for. The Bank of Japan monetary policy statement release is not going to be one of those situations where you can put in a order, a buy or a sell, stop order, limit order, because the Bank of Japan, with its tentative timing, is going to make it a little bit difficult because you don't know whether it's going to trigger those prices before the news is being released. So the Bank of Japan news is something that you want to be there for rather than to set your orders and hope that it hits your take profit. And lastly, the ECB, the European Central Bank for the euro, with the main financing rate. Main financing rate is interest rate at 7:45 GMT plus 8. Monetary policy statement 7:45 at GMT plus 8, and the press conference at 8:30 GMT plus 8. What you'll notice here is that as you go through, as you try and trade this ECB, is that rates are always going to be the same. Statements at 7:45 will have the first big jump, and then at 8:30 the press conference is going to be one of the most, or the second most exciting trading scenarios that you might come across. Actually, the third most exciting. I will rank FOMC number 1, non-farm payrolls number 2, and then the ECB press conference is number 3, at 8:30 p.m. GMT plus 8, you would see the euro US dollar going through a lot of volatility at that point as they talk about their decisions on the rates, their decisions and the way they came about that decision in the policy statements, and their future plans for the Eurozone. Remember, in the previous session, I actually shared with you saying that the Euro US is one of the most volatile pairs that you want to be trading, or you don't want to be trading if you're new, but it is also one of the pairs that you want to be most careful with, because at that press conference, you're going to see a lot of volatility. You're going to see markets jumping quite wildly. So be very careful of that. Other central banks will release interest rates decision, will release statements, but they don't do press conferences. One of them that you want to pay attention to, take a note of this, is the Aussie, the Reserve Bank of Australia. They do release their interest rates decision or the cash rates on the first Tuesday of every month. First Tuesday of every month, it is released at about 11 a.m. or at about noon, depending on daylight savings or not. GMT plus 8. Okay, so, but at those events, they seldom change too much. Statements will change a little bit. You want to pay a bit of attention to that. I do a lot of analysis and a lot of planning, especially for the Aussie and also for the New Zealand Dollar Traders Club members. You would have seen my video for the New Zealand Reserve Bank of New Zealand rate decision. I know that a lot of you have been making money on that already. Please watch the videos that I upload on Traders Club. It's going to be massively beneficial, not just to guide you before the news, also to guide you through the news that is being released. The next point, consumer price index. I'm going to take a 5 minutes, get some water. I'll get back to it. We'll see you back in 5 minutes. And we are back for the Consumer Price Index. Consumer Price Index, or CPI, is a measure of price level of a basket of consumer goods and services. Consumer Price Index, or CPI, is a change in price levels. Okay, it indicates the change in the cost of living. It's also what we call an indicator of inflation. This target for a CPI for all or most economies is between 2 to 3%. As you see, the central banks will try and achieve that rate of inflation. What happens if inflation is too high, or what happens if inflation is too low? Central banks will take action to try and slowly adjust it back towards 2.3%. I'll show you one of the tools that they use to adjust CPI back towards 2 to 3%. One of the things you want to focus on for CPI, New Zealand CPI numbers quarter on quarter, Aussie CPI numbers quarter on quarter, Pound CPI numbers year on year, CAD CPI numbers month on month, US CPI numbers month on month for core CPI and normal CPI numbers. So what you'll notice here is they are ranging between quarters, month, and years. And what you also notice is that we have not not included the euro and also the Japanese yen. For the US CPI numbers, it is broken up into CPI and core CPI numbers. The core CPI numbers excludes food and energy prices, and this actually gives a better representation of the overall inflation levels in the US, and that's one of the numbers that people actually pay more attention to, the core CPI numbers compared to the CPI numbers. Okay, so remember, CPI is an inflationary indicator. Central bankers want to keep or want to adjust CPI numbers towards 2 to 3%. And CPI numbers, inflationary numbers, are not something that you can flick a switch and get it to 2 or 3%. It is something that you balance. It's something that you balance through employment, through growth of wages, through better economies, better businesses, increasing GDP, and also interest rates. Interest rates, which is the flow of money. So the country's central bank uses interest rates as one of their many tools to manage how quickly or slowly the economy grows, to manage the speed. And this speed, or how quickly or slowly the economy grows, is that inflationary number, that 2 to 3% for CPI. Because if the economy grows, although it's preferred if it grows too quickly, it's going to be a bubble. Central banks want economies to grow, but they want it to grow consistently. They want it to be sustainable. They don't want a big growth and a burst, a big growth and a burst. Central banks would like to see the economy grow steadily over time, 2 to 3% over and over and over again. But remember, interest rates are broken into two forms. Interest rates paid when borrowing, that's credit rates, or interest rates paid or received when saving, deposit rates. When you're trading FX, you want to focus more on the impact of deposit rates. That's money that you receive when savings. Because there will be a greater demand for currencies with higher interest rates. Right now, we're actually seeing scenarios where economies are going through low interest rates, low to negative interest rates for an extended period of time because of the whole COVID situation, because of what's happening in the markets. They're cutting interest rates lower to zero or to negative so that people will be less likely to save, more likely to invest, more likely to pump the money back into the economy to stimulate activity in the economy. I'll give you a better example of that. Say your local bank is paying you an interest rate of 0.5% per annum for your US dollar deposits. And you just found that banks in Australia will be paying you, for example, interest rates of about 6%. What would you do? At this point, would you put your money in your bank at 0.5% per annum, or would you put your money in Australia at 6% interest rates? What would you do? Would you leave it in the bank and be happy at 0.5, or change your money to Australian dollar and deposit into the Australian bank to earn 6%? I hope most people would have answered to change their money to Australian dollar, and this would actually demonstrate that reason. A higher interest rate will increase the demand for the currency, as everyone would shift, or most people would shift from the US dollar into the Australian dollar, buying more Australian dollar, increasing the overall value of the Australian dollar so that they can deposit into the Australian bank. To give you an example, further example, we are increasing interest rates. As interest rates increase, get higher, this would encourage households and businesses to save more rather than to invest. Because imagine now you're getting 10% interest rates. Would you rather get 10% putting your money in the bank, or would you go into the markets and try and generate 10% returns? Naturally, you put it in the bank, save and get 10%. That's what happens when you have increasing interest rates. This would mean that less money is being circulated, or less money is being pumped into the market. The value of the currency will increase as more people buy into that currency so that they can take advantage of the increasing interest rates. Value of currency increasing will make exports more expensive. Ultimately, as exports become more expensive and less money is being pumped into the market or circulated in the market, and the value of the currency starts increasing, this is likely to cause a slowdown in the business activity. So you can see that if the central banks feel that the economy is growing too quickly, which is becoming unsustainable, what they're likely to do is they will increase interest rates so that they will encourage saving, have less money pumped into the market, increase the value of the currency, make exports more expensive, and slowly slow down the business activity overall. But that's not the situation we are facing right now. The situation we are facing right now is where central banks are looking to cut interest rates. They're looking to reduce interest rates to zero. They're looking to reduce interest rates to less than zero, to negative. So you actually lose money putting your money in the bank. By cutting interest rates, this would encourage households and businesses to do what? To invest, to spend, to do something else rather than save, because putting your money in the bank, you lose money. You could do a lot of other things. Trade, invest, spend, and you can actually have a better return than putting your money in the bank. As this occurs, as cutting of interest rates occurs, this will mean that more money is being pumped into the market, more money is being circulated, less leakage out, more money circulated into the market. This is going to increase the supply of the currency. It's going to decrease the value of the currency. More money being pushed into the market. As supply increases, you're going to see the value of the currency drop. This is going to make exports a lot cheaper because value of the currency drop. Importers need less of that currency to get stuff imported. Exports become cheaper. These exports being cheaper would mean that production would have to increase as people buy more. So increasing production, making exports cheaper, would lead to an overall increase in business activity. So you see that at this point now, central banks across, or central banks globally, are taking on this approach of cutting interest rates, or they have taken this approach of cutting interest rates. A lot of central banks right now are at the point of waiting, because they're at a point of, we have cut enough, we're close to zero or negative. They've done all they can. They're looking at whether business activity will increase over time. So those are the two ways of how they can manage inflation or manage the overall business activity, the growth of the economy, through increasing or cutting interest rates. With interest rates, what you want to focus on is the New Zealand US dollar, or the Reserve Bank of New Zealand interest rates decision, the Aussie interest rates decision, as I told you, first Tuesday of every month at about 11 or 12 o'clock GMT +8, the pound interest rate decision, the Canadian interest rates decision, and the US dollar interest rate decision. As usual, we have overlooked the euro and also the yen interest rates decision, mainly because they are already in the negative interest rates zone, and they have not indicated any further likelihood to change their interest rates approach. And they haven't done so for a very long time as well. So because of this, we are going to focus more on New Zealand, Aussie, pound, Canadian, and the US dollar interest rates decision. If you have not already been following it, the New Zealand dollar are coming towards a very interesting point of their interest rates, whether they're going to go into negative rates or whether they need to go into negative rates, possibly towards the end of the year or early next year. So what you'll notice here is that we went through all that whole pyramid, starting from the top, central banks, looking at the monetary policy statements, looking at the interest rates decision based on the CPI numbers. We've looked at the governments, GDP numbers. We looked at the banks with their building permits. We've looked at the businesses with their purchasing managers index, the PMI. We've looked at households with the employment numbers. And also we've looked at households with the consumer sentiment. These are the 7 news items that I would like you to pay attention to when you're trading. Any event in the news, anything outside of that could impact prices, but the impact is going to be a bit more volatile. That means that it could be affected by several different situations, several different scenarios, or external factors. The ones that I've highlighted to you, the 7 that I've highlighted to you, are the most likely to have a slightly more consistent result. In the event that we see a good news, we're more likely to see the dollar appreciate, or we see a bad news, we're more likely to see the dollar depreciate. More consistent result. With that, we're looking at common questions.